Hi, everybody, and welcome back to video number 11 in Chapter 17. And when we left off, we were looking at identifying the proper accounting for losses on long-term contracts. Okay, number one, loss in the current period on a profitable contract. On a percentage of completion method only, the estimated cost increase requires a current period adjustment of gross profit recognized in prior periods. And number two, loss on an unprofitable contract under both percentage of completion and cost recovery methods, the company must recognize in the current period the entire expected contract loss. So if we assume that on December 31, 2026, Hard Hat estimates the cost to complete the bridge at $1,468,962 instead of the $1,134,000. Assuming all other data are the same as before, Hard Hat would compute the percent complete and recognize the loss as shown in the following illustration. And here was the cost to date and the estimated cost to complete revised. And so our estimated total costs are now $4,384,000. Our percentage complete would be 2/3 of the way, and the revenue recognized would be essentially 2/3 of the 4,500,000 less the previous 1,125,000. So the costs incurred in 2026, 1,916,000, representing a loss recognized in 2026 of $48,500. Okay, and the journal entry, pretty much as you would expect, will debit construction expenses for $1,916,000 and credit construction in process, a loss, $48,500, and will credit revenue from long-term contracts of $1,867,500. Hard Hat will report the loss of $48,500 on the 2026 income statement as the difference between the reported revenue of $1,867,500 and the costs of $1,916,000. Okay, a loss on an unprofitable contract. Here we're going to assume that on December 31, 2026, Hard Hat Company estimates the cost to complete the bridge at $1,640,250 instead of the $1,134,000. So the revised estimates for the bridge contract are as follows. Here was our original estimate, and then here our revised estimate, resulting in an estimated loss of $56,250. And we get this estimated total cost by taking the $2,916,000 plus the cost to complete of $1,640,250. Okay. Now, Hard Hat recognized $125,000 of gross profit in 2025. This amount must be offset in 2026 because it is no longer expected to be realized. In addition, since losses must be recognized as soon as estimatable, the company must recognize the total estimated loss of $56,250 in 2026. So, Hard Hat must recognize that total loss of 181,250, which is the 125,000 plus the 56,250. Okay, here our revenue was $4.5 million. Our percent complete was 64%. Again, that is that calculation we made earlier. This time we'll take the 2,916,000 divided by the $4,556,250, resulting in 64%. And so the revenue recognizable to date will be 2,880,000 less the revenue recognized prior to 2026, 1,125,000. Therefore, the revenue recognized in 2026 would be $1,755,000. Okay. All right. Now, to compute the construction cost to be expensed in 2026, Hard Hat adds the total loss to be recognized in 2026, which we did earlier, to the revenue to be recognized in 2026. So here we have the 1,755,000 that we just did on the previous slide, and then we added the two loss in at 181,000. So we add that to the revenue recognized to get the construction cost expensed in 2026 of 1,936,250. The journal entry for that would be the 1,936,250 as construction expenses. Now our loss has gone to 181,250, and our revenue from long-term contracts 1,755,000. And the balance sheet, I should say, the content of the construction and process account at the end of 2026. The construction in process has a balance of 2,859,750 as shown here. And here's our construction costs in 2025, then 2026, and our recognized loss of 181,250. Okay, Hard Hat also would recognize the contract loss of 56,250 through the following entry in 2026, the year in which the loss first became evident. And so we're going to debit loss on long-term contracts for 56,250 and credit construction in process loss for 56,250. Okay, now we're going to look at explaining revenue recognition for franchises. There are 4 types of franchising arrangements which have evolved over time. 1, the manufacturer to retailer. 2, the manufacturer to wholesaler. 3, the service sponsor to retailer. And 4, a wholesaler to retailer. 2 sources of revenue for franchise companies. Number 1, we're going to sale of the initial franchises and the related assets or services. And then number 2, continuing fees based on the operations of those franchises. Okay, the franchisor normally provides the franchisee with 1, assistance in site selection, 2, evaluation of potential income, 3, supervision of construction activity, 4, assistance in acquisition of signs, fixtures, and equipment, 5, bookkeeping and advisory services. 6, employee and management training. 7, quality control. And 8, advertising and promotion. Of course, the franchisor wants the franchisee to be successful. So, the performance obligations relate to the right to open a business, to using the trade name or other intellectual property of the franchisor. 3, continuing service such as marketing help, training, and in some cases supplying inventory and inventory management. And the initial fee and continuing franchise fees, the franchisor commonly charge an initial franchise fee and continuing franchise fees. Okay, the initial franchise fee, that's the big one, and that's the payment for establishing the relationship and providing some initial services. And then there's a continuing financial franchise fees received in return for continuing rights granted under the agreement and for providing management training, advertising, promotion, legal assistance, and other support, such as McDonald's. Okay, franchise example. Tums Pizza Incorporated enters into a franchise agreement on December 31, 2025, giving Food Fight Corp the right to operate as a franchisee of Tums Pizza for 5 years. Tums charges Food Fight an additional franchise fee of $50,000 for the right to operate as a franchisee. Of that amount, $20,000 is payable when Food Fight signs the agreement, and a note balance is payable in 5 annual installments of $6,000 each on December 31st. As part of the arrangement, Tums helps locate the site, negotiate the lease or purchase of the site, supervise construction activity, provide employee training and equipment necessary to be the distributor of its products. Similar training services and equipment are sold separately. Food Fight also promises to pay ongoing royalty payments of 1% of its annual sales, payable each January 31st of the following year, and is obligated to purchase products from Tums at its current standalone selling price at the time of purchase. The credit rating of Food Fight indicates that money can be borrowed at 8%. The present value of an ordinary annuity of 5 annual receipts of $6,000, each discounted at 8%, is $23,957. The discount of $6,043 represents the interest revenue to be accrued by Tums over the payment period. So, what are the performance obligations in this arrangement and the point in time at which the performance obligation for Tums are satisfied and revenue recognized? To identify the performance obligations, Tums must determine whether the promised rights, site selection and construction, services, training services, and equipment are distinct. So, the rights to the trade name, market area, and proprietary know-how for 5 years are not individually distinct because each one is not sold separately and cannot be used with other goods and services that are readily available to the franchisee. Therefore, those combined rights give rise to a single performance obligation. Tums satisfies the performance obligation to grant those rights at a point in time when Food Fight obtains control of the rights. That is, once Food Fight begins operating the store, Tums has no further obligation with respect to these rights. That looks like a good place to stop this video, and when we return, we'll continue on with the solution for this franchise example. Until that time, bye for now.